Welcome to my channel. I'm so glad you're here. Today we're diving into something really important that you won't want to miss. If you enjoy thoughtful content, don't forget to like, share, and subscribe. And follow us on whichever social media platform you're watching. Your support means everything. Now let's get into today's topic.
Welcome to the deep dive. If you've been watching the financial world, crypto adoption in 2025, it's not just growing anymore, is it? It feels like a full-blown financial
It
revolution.
really does.
And, well, with that comes something undeniable. Governments. They're
Yeah.
not just watching now, they're regulating, they're taxing, they're auditing. Crypto isn't some, niche futuristic thing. It's a real financial asset, and it's squarely in the sights of tax authorities.
Absolutely. That's the reality now.
So what are we doing here today? What's our mission? We want to be your guide through this pretty complex maze of crypto taxation. It could be really counterintuitive.
Definitely.
We want to give you the knowledge you need to, well, potentially save thousands of dollars.
Right.
And maybe even more important, keep yourself out of legal trouble.
That's critical.
So whether you're, flipping NFTs, maybe day trading altcoins, or just holding Bitcoin for the long haul, this deep dive, it's for you.
Exactly. Look, the days of thinking your crypto holdings are somehow off the radar. They're just over.
Yeah.
Done. Tax law now fully covers this stuff. It's not just for traditional assets anymore. And agencies like the IRS in the US, HMRC in the UK, and, well, their counterparts everywhere.
Yeah.
They're watching. They're equipped.
They're getting data too, right, from exchanges.
Oh, yeah. Many big exchanges are legally required now to share user data directly. So the main point here is just not knowing the rules. That's not going to save you. Ignorance isn't a defense.
Right. And that's exactly why we're doing this. We're going to break down the how, the why, and the really crucial what of crypto taxes. We'll give you some real-world examples, some pro tips, so you're not just compliant, but maybe even a bit strategically ahead. So let's just jump right in.
Let's do it.
Okay, first things first. Let's unpack the basic idea. What is crypto taxation, really?
Well, at its heart, it's pretty simple. It's your financial obligation, basically your tax duty, for earnings or transactions involving digital currencies.
Okay, so maybe think of it like your stock portfolio. If it grows, you owe something on the gains. Is that kind of the idea?
That's a good analogy. In theory, it's that straightforward. But the how gets tricky. And what really drives your tax situation with crypto is how governments classify it. This is fundamental.
Okay.
In most big countries, cryptocurrencies are treated as property, not as currency.
Property, like real estate or stocks.
Exactly like that. So in the US, for instance, the IRS views crypto as a capital asset. And the implication is huge. It means pretty much every transaction, no matter how small, technically needs to be tracked and reported.
Wow. Okay. Even tiny ones.
Yep. Now, there are a couple of exceptions globally, like El Salvador and the Central African Republic made Bitcoin legal tender. But even there, for tax reporting, especially internationally, it often still follows property-like rules. It's complicated.
Okay, and here's something I think trips a lot of people up. This idea of double taxation. Can you explain that?
Right.
Because it sounds bad.
It can be a headache, yeah. So if you just buy crypto and hold it, that's generally a capital asset. You pay tax on the gain or loss when you sell it. Simple enough. But if you earn crypto maybe through mining or staking rewards or getting paid for a job in crypto,
Okay.
it's first taxed as ordinary income right when you receive it at its fair market value on that day.
Ah, okay. So income tax first.
Exactly. Then let's say you hold on to that crypto and later sell it for more than it was worth when you got it.
Yeah.
You pay capital gains tax on that increase. So yes, you can absolutely end up being taxed twice on the same crypto asset. Once as income, once as a capital gain.
Oof. Okay, that's crucial to understand. So why are governments pushing so hard to tax crypto now? Is it just about the money?
Well, getting revenue for public services is definitely part of it, obviously. But it's also about control and regulation. They want to prevent things like money laundering, tax evasion, illicit financing.
Makes sense.
And if you connect this to the bigger picture, like the rise of central bank digital currencies, CBDCs.
Right, the government issued digital currencies.
Yeah. There's this strong push to apply the same financial rules we have for traditional money to this new digital world. It's about bringing some order to what used to feel like the Wild West of finance.
Okay, bringing order. Got it. So with that foundation laid, let's get practical. What specific actions actually trigger a tax event? What makes the tax man take notice?
Right. Let's talk triggers.
The most obvious one, I guess, is just selling crypto for regular money, right? Like selling Bitcoin for dollars or pounds.
That's the big one, definitely. When you cash out crypto into fiat currency, you trigger a capital gain or a capital loss.
And what determines how much tax you owe then?
Three key things. First, your cost basis, basically, what you originally paid for the crypto, including fees.
Yeah.
Second, how long you held it. And third, the price you sold it for.
Okay, so an example. Let's say I bought one Bitcoin for $20,000 back in 2023. And then in 2025, I sell it for $40,000.
Right. That $20,000 difference, the gain, that's taxable. It's super direct because it hits the traditional banking system. Very visible.
Gotcha. Visible is the key word there. Now, what about something maybe less obvious?
Okay, here's a really common trap, especially for active traders. Trading one crypto for another.
Ah, so swapping, say, Ethereum for Solana?
Exactly. That's not just a swap in the eyes of the tax authorities. It's treated as if you sold your Ethereum
Okay.
and then immediately bought Solana. So the sale of the ETH is a taxable event. It doesn't matter that no dollars or euros were involved.
Wow. So if you're trading a lot between different coins.
You could rack up hundreds, even thousands of taxable events in a year, each one needing to be documented. It's a huge record-keeping challenge.
Okay, that is a trap. Now, here's one that I know blows people's minds.
Yeah.
Using crypto to buy stuff, like actual goods and services.
Yep. This one surprises almost everyone. Buying a cup of coffee with Bitcoin.
Yeah.
Technically, that's a taxable event, seriously. Because you're disposing of the Bitcoin, you have to figure out the difference between what you originally paid for that fraction of Bitcoin and what it was worth at the exact moment you bought the coffee. That difference is a tiny capital gain or loss you need to report.
For a coffee. That seems intense.
It is. Now, there's talk about maybe bringing in de minimis exemptions, basically, rules that say super small transactions like that coffee don't count.
Okay, that would make sense.
It would. But for now, in most places, the strict rule applies. Every little bit technically counts.
Okay, noted. Strict rules for now. What about getting crypto? Like as payment for work?
Ah, yes. Receiving crypto as payment or salary. This is super important. It's treated as ordinary income.
Okay, income, not property gain initially.
Right. It's income valued at its fair market value, or FMV, on the day you receive it. That FMV also becomes your cost basis for that crypto going forward.
Can you give an example?
Sure. Let's say you do a freelance gig and you get paid 0.05 BTC. And on that day, the FMV of Bitcoin is, say, $60,000. That means you've received $3,000 worth of income. 0.05, $60,000. You need to report that $3,000 as ordinary income, just like if you got paid in cash.
And then if I sell that BTC later for more...
Then you'll have a capital gain on the increase, like we talked about, that dual tax thing again.
Right. Income first, potentially capital gains later.
Exactly. And if you're self-employed, remember, you'll likely owe self-employment taxes on that income too.
So the key takeaway is record keeping again, isn't it?
Absolutely non-negotiable. You need the date, the FMV at that exact moment, the wallet address it came from or went to, the purpose, everything. Are you doing that for every crypto payment you get? It's crucial.
It sounds like a lot to track. Okay, beyond direct payments, what about other ways people earn crypto? Like mining or staking or getting airdrops?
Good question. Let's break those down. Mining rewards. If you mine crypto, that's generally considered self-employment income.
Okay.
You report the fair market value of the coins you mine on the day you receive them. The good news is you might be able to deduct expenses related to mining, like electricity costs.
Right, makes sense. What about staking?
Staking rewards are also taxable income. Generally, they're taxed the moment you gain control over them, meaning when they land in your wallet and you can access them, even if you don't sell them right away.
So as soon as you can use them, basically.
Pretty much. And then airdrops, those free tokens that sometimes just appear in your wallet.
Yeah, those can be confusing.
They're considered taxable income too, again, at their fair market value on the day they arrive in your wallet, even if you didn't ask for them.
Seriously, even unsolicited ones?
Yep. And here's the tricky part. The value is locked in on day one. So let's say you get an airdrop token worth $500 when it arrives.
Okay.
But maybe next week its value crashes to $5. You still owe income tax based on that initial $500 value.
Ouch. That could really sting.
It definitely can. It makes tracking the FMV of obscure new tokens really important and sometimes difficult. So here's a quick pro tip, especially if you're active in DeFi or chasing new token launches. Use a crypto tax platform. Seriously. Get one early.
Like software to help track all this?
Exactly. They're designed to automatically pull in data, categorize these weird DeFi transactions, staking rewards, airdrops, It can save you an incredible amount of time and headache.
Okay, that sounds essential for active users. So we know what triggers taxes. Now, how do you actually calculate what you owe? Let's get into the nuts and bolts.
Right. Calculation time.
First up, you mentioned cost basis before. Can you define that a bit more clearly? It seems really important.
It's absolutely fundamental. Your cost basis is basically the original value of an asset for tax purposes. For crypto you bought, it's the amount you paid plus any transaction fees.
Okay, purchase price plus fees.
Right. For crypto you earned, like through mining, staking, or getting paid. Your cost basis is the fair market value at the moment you received it, the value you reported as income.
Got it. And you need that to calculate gains or losses.
Right, precisely. Your capital gain or loss is simply the sale price minus your cost basis. Without an accurate cost basis, you can't calculate your taxes correctly.
Okay, crucial. Now, you also mentioned holding periods. Let's talk about short-term versus long-term capital gains. How big a difference did that make?
It can make a huge difference to your tax bill. It's one of the most important distinctions.
How so?
Short-term capital gains come from selling crypto you held for less than 1 year. These are taxed at your regular ordinary income tax rates.
Which can be pretty high, right?
Yeah, in the U.S., that could be up to 37%, depending on your income bracket. It's taxed just like your salary.
Okay. And long-term?
Long-term capital gains are for crypto you held for more than 1 year. These get preferential treatment, much lower tax rates.
Oh, much low.
In the U.S., typically 0%, 15%, or 20%, again, depending on your overall income. So significantly lower than ordinary income rates for most people.
Wow. Okay, so the message is pretty clear then. Holding for longer than a year is generally much better tax-wise.
Almost always, yes. It's usually much more tax efficient if you can manage it. Patience pays off.
Good to know. Now, when you do sell, I hear there are different ways to figure out which specific coins you sold, especially if you bought batches at different times and prices. These accounting methods.
That's right. This gets a bit technical, but it's powerful. The main methods are FIFO, LIFO, and specific identification.
Okay, break those down. FIFO.
FIFO stands for first in, first out. It assumes the first coins you bought are the first ones you sell. This is often the default method tax authorities assume if you don't specify otherwise.
And how does that usually work out tax-wise?
In a rising market, FIFO often results in higher capital gains because you're selling the older coins that you likely bought at a lower price.
Okay. What about LIFO?
LIFO is last in, first out. It assumes the most recent coins you bought are the first ones sold. In a rising market, this could potentially lower your immediate tax bill because you might be selling coins you bought at a higher price more recently. However, LIFO isn't always allowed for crypto. You have to check your local rules. The IRS, for example, hasn't explicitly approved LIFO for crypto.
Okay, so LIFO is maybe less certain. What's the third one? Specific identification.
Specific identification, or Spec ID. This is often the most advantageous, but it requires the best record keeping.
How does it work?
It allows you to choose exactly which batch or even which specific units of crypto you are selling. So if you bought Bitcoin at $10 make, $30K, and $60K, and you want to sell some now, you could specifically choose to sell the ones you bought at $60K to minimize your capital gains or even realize a loss.
So you can strategically pick the coins with the highest cost basis to sell first.
Exactly. It gives you the most control to optimize your tax outcome. But again, the burden of proof is on you to show you tracked those specific units. That's where good software and records are vital.
Makes sense. Understanding these methods is clearly more than just theory. It's about active tax strategy. Okay, so once you've calculated everything, what about the actual reporting requirements? What forms do people need to know about, especially in the U.S.?
Right, the paperwork. For U.S. taxpayers, the main form for reporting crypto sales and exchanges is IRS Form 8949. This is where you list out each transaction, the dates, proceeds, cost basis, gain or loss.
Okay, Form 8949 for the details.
Yep, and then the totals from Form 8949 get summarized on Schedule D of your main tax return, Form 1040.
And what about crypto earned as income?
That usually goes on Schedule 1 as other income, or if it's self-employment income from mining or freelance work, it goes on Schedule C. It ultimately flows through to your main Form 1040.
Got it. And isn't there now a direct question about crypto on the main tax form?
Yes, absolutely crucial point. Right near the top of Form 1040, there's a question that asks something like, at any time during the tax year, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency?
You have to check yes or no.
You do. And checking no when the answer should be yes is perjury. The penalties for being untruthful there can be severe. It signals to the IRS immediately whether they need to look closer at your return for crypto activity.
Wow. So no hiding. What about people holding crypto outside the U.S.?
Yeah.
Any international reporting?
Yes, for U.S. citizens, this is really important. If you have significant crypto holdings on foreign exchanges or in foreign wallets, you might need to file an FBAR, report of foreign bank and financial accounts, if the total value exceeds certain thresholds.
Okay.
And potentially Form 8938 under FTA, Foreign Account Tax Compliance Act rules as well. These are about disclosing foreign assets. Failing to file these when required can lead to absolutely massive penalties, sometimes even worse than penalties for unpaid tax itself.
Okay, that sounds serious. So tying this all together, what's the absolute best practice for dealing with all this complexity?
If I had to give one golden rule, it's this. Keep everything.
Everything.
Every record. Transaction dates, the type of coin, the amount, the value in your local fiat currency at the time of the transaction, the wallet addresses involved, the exchange you use, the purpose of the transaction, all of it.
Why is being that meticulous so important? Isn't it overkill?
It's not just about being ready for an audit, though that's huge. It's also what enables those tax-saving strategies like specific identification. You can't possibly pick the highest cost basis coins to sell if you don't have detailed records of when you bought each one and for how much.
Ah, so good records actually save you money, potentially.
Absolutely. They're your defense and your offense for tax purposes. And thankfully, you don't have to do it all manually in a spreadsheet anymore, though you could.
Right, those software tools we mentioned earlier.
Exactly. Tools like CoinTracker, Coinly, Token Tax, Zenledger, Accounting. They connect to your exchanges and wallets via API or CSV uploads and automate a huge amount of this tracking and calculation. They're practically essential now for anyone even moderately active in crypto.
Okay, so investing in one of those tools seems like a very smart move.
Definitely. Do it early in the year. Don't wait until tax season panic sets in.
Good advice. Now, let's broaden our view a bit. We focused a lot on the U.S. How does crypto taxation look around the world? Is it the same everywhere?
Oh, definitely not. It's a real patchwork globally, though there are common themes.
Give us a few highlights. How do some other major countries handle it differently?
Okay, well, the UK is quite similar to the US treats crypto as property subject to capital gains tax, CGT, and income tax where applicable. Canada is interesting. Crypto activity can be treated either as capital gains or as business income, depending heavily on the frequency and nature of your trading. More like a business if you trade a lot.
Okay.
Australia also generally treats it as property subject to CGT, but they have a potentially useful personal use asset exemption for small amounts of crypto bought and used quickly for personal items, though the threshold is AUD $10,000 acquisition costs, so it's quite specific.
Interesting. Any really different approaches?
Yeah, India stands out. They implemented a flat 30% tax on all crypto gains, with almost no deductions allowed except the original purchase costs. No offsetting losses against gains either. Plus, they have a 1% tax deducted at source, TDS, on many crypto transactions, which really impacts liquidity and trading behavior.
Wow. 30% flat and 1% TDS. That's harsh.
It's definitely shaped the market there. And then you have places like Germany, which has historically been quite favorable. If you hold crypto for longer than 1 year, the gains become completely tax-free.
Tax-free after a year. That's amazing.
It has been, yeah. The rules can change. Portugal used to be seen as a crypto tax haven, but they've recently introduced taxes, especially for professional traders. The point is, it varies wildly. You have to know the rules for your specific tax residency.
Absolutely critical. It really underscores the need for localized advice or tools that handle different jurisdictions. Which brings us back to those tools and software. We've named a few, but what should people look for in a good crypto tax tool?
Good question. Key features are auto-syncing with major exchanges and wallets that saves huge amounts of manual entry. Reliable cost basis tracking using various methods like FIFO or Spec ID if you choose. Ability to correctly categorize complex DeFi transactions, staking, airdrops. And finally, generating the specific tax reports needed for your country, like Form 8949 for the US.
So integration is key. Does it connect easily with places like Coinbase, Binance, Kraken, MetaMask, Ledger?
Exactly. Most top platforms do connect with the big players, usually through secure API keys or by uploading transaction history files, CSVs. Check compatibility before you commit.
And your advice again is get one early.
Yes. Invest in a good tool early in the tax year, or even better, use it throughout the year to keep track. It turns tax season from, frankly, a potential nightmare into something manageable.
Solid advice. Now, even with tools, people make mistakes. What are some of the common pitfalls or errors you see people making when filing crypto taxes?
Oh, there are definitely recurring themes. A big one is still ignoring small transactions. People think, it was just a few dollars worth of trading, or it was just buying that coffee.
Well, as we said, it all technically counts, right?
It does under current rules in many places. Those small amounts can add up, and ignoring them shows a lack of diligence if you get audited. Another huge one is not reporting to FI earnings.
Like staking rewards, yield farming.
Exactly. Staking rewards, liquidity pool income, yield farming profits, even things like wrapping and unwrapping tokens, or getting governance tokens from airdrops. Tax agencies are getting much savvier about looking for this stuff. You can't assume it's invisible.
Okay, DeFi is definitely on the radar. Any other common mistakes?
Yeah, misunderstanding lost or stolen crypto. People assume they can just claim a big loss if their keys are lost or crypto is stolen.
Can't they?
It's actually very difficult. You need to provide strong proof that the crypto is permanently and irretrievably lost with absolutely no chance of recovery. That's a high bar to meet. Simply losing your keys might not be enough.
Wow, okay, that's tougher than people think.
And one more. Not updating cost basis correctly after events like hard forks, where a blockchain splits, or certain types of airdrops. If you receive new coins from a fork, they might have a cost basis of 0, or it might be allocated from the original coin. Getting this wrong throws off all your future calculations when you sell.
Okay, lots of ways to stumble there. Let's switch gears slightly. What if things go wrong in the other direction? What about losses? Can crypto losses actually help you on your taxes?
Yes, absolutely. This is important. While nobody likes losses, they can reduce your overall tax bill through tax loss harvesting.
How did that work?
If you sell crypto for less than you paid for it, your cost basis, that's a capital loss. You can use these capital losses to offset capital gains you might have.
Offset gains from other cryptos.
Yes, and also potentially gains from other investments, like stocks. The rules vary by country, but generally losses offset gains.
What if your losses are bigger than your gains in a year?
Good question. In many places, like the U.S., if your total capital losses exceed your total capital gains, you can deduct a certain amount of that excess loss against your ordinary income.
Like your salary.
Exactly. In the U.S., it's typically limited to $3,000 per year against ordinary income.
Okay, so $3,000 off your regular income tax.
Potentially, yes. And if you have even more losses beyond that, you can usually carry those losses forward to future tax years to offset future gains. So losses aren't wasted, they can have value down the road.
That's actually a really valuable silver lining.
Mhm.
Now, related to losses, there's something called the wash sale rule. Does that apply to crypto? It's kind of a big deal in stocks.
The wash sale rule. This is a fascinating and currently very advantageous point for crypto in some places.
Explain the rule first for those who don't know.
Okay. In traditional markets like stocks, the wash sale rule prevents you from claiming a capital loss on selling a stock if you buy back the same or a substantially identical stock within 30 days, before or after the sale.
Right, so you can't just sell for a loss on the 10/30th and buy it back Jan 1st just to get the tax break.
Exactly. It stops that kind of artificial loss generation for tax purposes. But here's the kicker.
Yeah.
Currently, in many major jurisdictions, including the United States, this wash sale rule does not apply to cryptocurrencies.
Seriously. So you can sell crypto at a loss and buy it right back.
Technically, yes. As of now, because crypto is generally classified as property and not a security by the IRS, the securities wash sale rule doesn't cover it. So you could sell Bitcoin at a loss today, claim that loss to offset gains, and buy Bitcoin back immediately, maintaining your investment position while banking the tax benefit.
That seems like a loophole. A pretty significant one for active traders.
It is. It provides a lot of flexibility for tax loss harvesting in crypto that doesn't exist for stocks. But big caveat here.
What's that?
Regulators are very aware of this discrepancy. There's ongoing discussion and proposals to close this loophole and apply wash sale rules to crypto to create parity with securities. So while it's an advantage now, don't count on it being around forever. It might disappear soon.
Okay, good warning. Use it while you can, maybe, but be prepared for it to change. Now, what happens if someone doesn't follow the rules? What's the reality of the IRS crackdown and the legal implications? Is it just theoretical?
Oh, it's far from theoretical. The enforcement is very real and definitely ramping up.
How does it usually start? Do they just raid your house?
Usually not that dramatic initially. It often starts with automated notices. The IRS computer systems match information they receive from exchanges with what you report on your tax return. If there's a mismatch, you might get a notice like a CP 2000.
What's that?
It basically says, hey, we see this income or transaction that doesn't seem to be on your return. Explain. They also send out soft letters sometimes, just reminding people of their crypto tax obligations based on data from exchanges.
Okay, so a letter first. What if you get one? Panic.
Don't panic, but don't ignore it either. Respond promptly and accurately. Provide the documentation they ask for. Ignoring it will only make things worse.
What if it escalates? What does a full audit look like?
A full crypto audit can be pretty invasive. They'll want everything. Detailed transaction histories from all your exchanges, records from your personal wallets, maybe even bank statements to trace fiat movements. They'll scrutinize your cost basis calculations. They might ask for specific wallet addresses. It requires thorough preparation and often professional help.
Sounds stressful. And what are the actual penalties for non-compliance if they find you owe taxes or didn't report correctly?
They can be pretty steep. You're looking at accuracy-related penalties, which can be 20% or more of the underpaid tax. If they deem it fraud, penalties can jump to 75%. Plus, you'll owe interest on the unpaid tax, which compounds over time.
Ouch. 20% to 75% plus interest.
And in serious cases of willful tax evasion, it can even lead to criminal prosecution, fines, and potentially jail time. It's not just about money.
Criminal charges, too. Wow. How are they even finding people if they use, say, decentralized exchanges or foreign platforms?
That's where things like the John Doe summons come in. The IRS has successfully used this legal tool to force even major exchanges like Kraken, Coinbase, Binance to hand over bulk data on users who meet certain transaction thresholds.
So they can just demand data on thousands of users at once.
Yes. They don't need to know your name beforehand. They summon the exchange for records on anyone who traded over, say, $20,000 in a year. It casts a wide net. So the idea that you're anonymous or invisible, especially if you ever touch fiat ramps or major platforms, that's increasingly naive. They have ways to find you.
Okay, the message is clear. Compliance isn't really optional anymore. Looking ahead, then, what's on the horizon for the future of crypto taxation? More rules.
Almost certainly yes. The trend is towards tighter regulation and increased transparency globally.
Any specific things coming down the pike?
Well, in the U.S., the Infrastructure Investment and Jobs Act that passed a few years ago contains provisions that are still being finalized. A key part is expanding the definition of a broker for tax reporting purposes.
What does that mean?
It means entities that facilitate crypto transfers might be required to issue 1099-B forms, just like stockbrokers do, reporting users' sales proceeds directly to the IRS. And the definition of broker might be interpreted broadly to include some DeFi platforms, miners, or wallet providers. There's still debate around the specifics, but the intent is more direct reporting.
So, exchanges might start sending tax forms directly for gains and losses.
That's the direction things are heading. We might also see pushes for mandatory KYC, know your customer, on pretty much all wallets, not just exchange accounts. Maybe even real-time tax reporting built into blockchain transactions somehow.
Real-time reporting. Wow.
It's being discussed. The technology could potentially allow it.
And what about those CBDCs we mentioned earlier? How might they play a role? And blockchain itself.
This is where it gets potentially transformative, maybe a bit concerning for privacy advocates. CBDCs, being government-issued digital cash, could be designed with tax compliance built in. Because they're centrally controlled and traceable, transactions could potentially have tax implications calculated and maybe even remitted automatically at the point of sale. Imagine buying something and the sales tax, or VAT, is instantly deducted and sent to the government via the CBDC transaction itself.
Seamless for the government, less private for the user.
Exactly. And beyond CBDCs, some speculate that blockchain technology itself could be used to create highly transparent, tamper-proof tax systems. Your crypto wallet could theoretically auto-report taxable events directly to the authorities based on on-chain activity.
Auto-reporting wallets.
Again, it would streamline compliance massively, but it raises huge questions about financial privacy and surveillance. It's a potential future, but one with significant trade-offs.
Definitely a lot to think about there. Okay, let's start to wrap this up. If you had to boil down the main message from our deep dive today, what would it be?
I think the key takeaway is that crypto taxation has moved firmly out of the shadows. It's no longer something optional or vague or that you can ignore hoping it goes away.
Right. It's real, it's being enforced, and the rules are evolving really quickly.
Absolutely. And understanding